Hey there, everyone. Happy Friday the 13th. Today on the Final Bar, we'll talk about the risk-off move for growth stocks. The Nasdaq finishing down about 1.3% from Thursday's close. We'll kick off earnings season with banks and a couple other stocks before the open today. It is not a good start, folks. Finally, we'll open the Final Bar Mailbag. How long can the TLT, the bond ETF, continue to drop? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. We had some really good conversations this week, talking with Chris Verone yesterday, just a really good big picture assessment about trends and rotations and where we're seeing leadership, the lack of participation in small caps, which is a theme that's come up with a number of our guests. Earlier this week, guys like Adam Turnquist with some really interesting thoughts about the dollar and what to think about during earnings season, just getting kicked off here today. You know, I think a lot of investors, whether consciously or subconsciously, are sort of looking for an upside catalyst. There's certainly this growing body of information that's weighing on the market, certainly at the top of mind, the events in the Middle East, certainly with the possibility to continue escalating. Not too hard to see a scenario where that really starts to impact Western economies, where the dollar starts to spike, where safe havens really start to rally and risk off becomes the theme. We're seeing that, I think, going into this weekend. So certainly the news flow over the weekend could be vital as we make sense of things. Now, this is happening as earnings season is just kicking off. And if you look at the charts of some of the banks today, which we will do in our market recap, not super encouraging start to the reporting. Let's get to the market recap, see what sort of information we can tease out of the charts today. Before we get there, I want to answer a question that we had on our poll. So as a reminder, follow us on all the socials. Make sure you subscribe to our YouTube channel here. You won't miss the next question. We asked you which price pattern features lower highs and stable or flat lows, an ascending triangle, descending triangle, symmetrical triangle, or a broadening top. Correct answer is descending triangle, and props to Skybogs, our producer, for correctly answering that question. She's absolutely right. Descending triangle is basically where you have a flat bottom, a declining resistance level. We talked about with some of those charts like Tesla, sort of that symmetrical triangle where they're kind of a narrowing of the range, lower highs, higher lows. Think of it as the same kind of thing, but instead of higher lows, they're flat lows, and that's your descending triangle. More often than not, that pattern resolves to the downside when you break through that key support level. If you're not familiar with some of these price patterns, by the way, two things I would suggest you do. Number one, go to the Chart School section of StockCharts.com. It's a free portion of our website. Has all those patterns illustrated with some really good examples. Shows you how to detect the pattern and what sort of trigger you want to be looking for. And pick up a copy of Edwards and McGee's classic book, Technical Analysis of Stock Trends. That's where I first learned about some of those patterns. John Murphy's book on technical analysis, obviously, a winner as well. Let's get to the market recap and see how things played out today. As I mentioned, kind of a weaker day for sure. Now, yesterday we were looking at the evidence and sort of, mixed bag. Right? I mean, it wasn't horrible, sort of in the middle. Question is whether we're regaining the neckline of the head and shoulders pattern on the S&P. Today, the major average is pushing lower. Now, the Dow was actually slightly higher, but that's driven by some of the sectors that actually finished in the green. We'll talk about those in a minute. But the S&P 500 down about 0.5%. That puts us below 4330, and 4350 was that neckline that we've been talking about. So I think if we can't hold that neckline, I think, and again, I still think the overall trend is still distributive here. I'm seeing a distribution pattern based on trend, based on breadth conditions for sure. The NASDAQ composite leading the way lower. It actually bounced just slightly going into the close, still down about 1.25% from Thursday's close. Mid caps and small caps all down as well, and the S&P 600 small cap index down 1.2%, so continuing to underperform. The VIX actually spiking in a pretty big way today. So in this sort of environment, I think what you're looking for are signs of an escalating, what's the word I would look for? Bearishness, I guess, more than anything, more of a risk-off positioning. Now, the things you generally look for, besides the price of things going down, right? The S&P, the NASDAQ going down and unable to hold support. That's probably the most important thing you can look for. The second thing would be an increase in volatility, right? Because uncertainty, when people get nervous, they tend to act quickly. They tend to act very suddenly, and that creates sort of a feedback loop of overreaction to what's going on. That usually causes volatility to spike, and the VIX starts to push higher. So the VIX is getting closer to that 20 level. Now, just today, from yesterday's close, we're up a full 2.5 points on the VIX. The VIX was down below 17 yesterday. Now we're back above 19. So that didn't take much. And that's what we were sort of talking about. It's what I've been thinking of as we're looking at these charts. I've seen a bit of a bounce here, but it does not take much to make this market look really risk off very quickly. And I would say today is one of those days. Now, the third thing you can look at, which we'll get to in a minute, is basically looking at offense versus defense. And I would say we're certainly getting a sign of defense doing pretty well today. Certainly indications that markets are going a little more risk off. One of the ways you can gauge that sort of general risk assessment is a rally in the bond markets. In this particular environment, our investors going to the safe haven of the treasury markets. Pretty decent yield these days, and certainly a stable place to ride things out. You got that today. The TLT was up 1.8%. Rates coming down a bit. The 10-year yield around 4.63. The long bond yield is below 4.8%. The dollar, not too much of a change from yesterday. So the trend in the dollar has been positive, not a big spike or anything today. Where you are seeing a big move is in the commodity space, right? So one of the big, I think, fallouts or the big implications of an escalation in the Middle East, which certainly appears to be continuing here as we monitor the news here on Friday, is a risk to crude oil and crude oil supply, and certainly would most likely cause crude oil prices to go higher. I saw an estimate today from a strategist putting crude oil at $150 a barrel. If there becomes a wider, series of events in the Middle East, maybe Iran becomes involved, that would sort of take it to the next level. For now, it's relatively contained. Of course, pretty horrible things we're hearing, but it's for now limited impact. But the escalation continues, and all of a sudden you can see crude oil prices going up pretty quickly. That has a lot of implications for Western economies, for sure, which are very much driven by commodities and driven by crude oil, for sure. Today, you're seeing the DBC up 2.6%, gold prices up, the GLD was up 3.2%, silver up over 4%, the USO, which is a crude oil ETF, almost up 5% today. So you're seeing that move, one of those potential outcomes of events in the Middle East, certainly playing out today. Gold and silver have not had a day like this in quite some time. And I'll look at all of these charts individually, time permitting here through our market recap. And I'll show you how the charts are evolving based on this one-day movement. Kind of a quiet day for cryptocurrencies, given the movement in the VIX, given the drop in major equity averages, spike in commodities, rally in bond markets. You're seeing very little, relatively speaking, in the cryptocurrency space. It's kind of stable. I mean, maybe we're all watching the SBF trial and just sort of waiting and seeing how that plays out. I don't know, but Bitcoin essentially not too much different from yesterday, still a little bit below 27,000. Looking at the sector returns, energy up 2.2%. Now, crude oil prices pushing higher, certainly causing some upside there. A lot of individual names like ConocoPhillips and others with a nice rotation to the upside. Utilities number 2, 1.1. And look at this, consumer staples finally putting in a positive day, up almost 1%. So not a blowout, rally, but certainly consumer staples have been underperforming in a big time way. And we've talked about charts like Hormel, HRL, some of the other food product stocks, which have really been accelerating to the downside. Even given all of that backdrop, today you're getting a movement. Healthcare was number 4. So what's interesting is today you actually are finally seeing, at least for one day, a rotation to more defensive positioning. Not enough for me to tell you this is a broad rotation, right? The relative strength of offense versus defense, as we featured on yesterday's show, still very much favoring offense over defense. But today a bit of a change to that. The 3 FANG sectors, noteworthy at the bottom of the list. Consumer discretionary and technology, both down about 1.4%, followed by communication services, down 1.1%. Those are some of the biggest sectors in our benchmarks, which means if they're down, we're probably in a tough place. Let's look at the daily chart of the S&P 500, and you'll see what I mean about that neckline. I was talking about how, yesterday on the show, I was talking with Chris Ferrone about 4350, the neckline of this pattern. He was talking about the head and shoulders pattern. Chris's downside objective for the S&P was kind of down in this range, around 4050. He'd mentioned that 50% retracement level. That would validate or would complete the minimum downside objective to the head and shoulders top by my measurements. So that's a reasonable downside objective. I can't argue with that. 4,200 is first, though, right? Before you can get to 40.50, you have to first break 4,200. So I stand by that general thinking. The way that I'm thinking of this is a tactical decline within a long-term, medium-term uptrend until we break that 4,200 level. We break below the 200-day moving average, and oh boy, I almost sneezed. Sorry, guys. Break below that 4,200 level, and that's where I think you could validate more of a declining market that is potentially going much, much further. Now, what's interesting is on the chart of the S&P, and I've often mentioned recently, take a step back and just look at the overall trend. Clear pattern of lower highs and lower lows. Today, after yesterday's sort of drop, today we have a further decline. A lot of random little bearish engulfing patterns on the candle charts that are popping up, not necessarily just for the S&P, but a lot of individual names. And you're seeing the S&P get back below that 4350 level, back below trend line support. So I think overall, again, 4,200 remains that level. We break that, I immediately would think 4050 is the next objective, but you better believe I will be thinking about further downside objectives like 3,800 and what sort of moves that would involve, what sort of things would happen to risk assets, not just equities, but elsewhere also. Let's look quickly here at a couple of the other charts just randomly. Crude oil prices spiking higher. We're looking at the USO here, up almost 5%. What's interesting is if you look at the chart of the USO, just like the S&P is making a pattern of lower highs and lower lows, crude oil actually making higher highs and higher lows. And that's different from back here where the USO was essentially in a basing pattern, but overall still kind of drifting lower. Now all of a sudden you get higher highs, higher lows. So most recently we pulled back, made another higher low, and now we're rallying once again. So all eyes, I think, on the previous swing high around $82.50, $83, we'll call it, from mid-September. The GLD, and actually let me bring up this chart of the GLD because a big gap higher today. Gold has been a gappy chart at times, and gold overall has been a pretty underwhelming area of the market. Gold came up on my presentation earlier this week with my friends at CATA, which is the Canadian Association for Technical Analysis. Shout out to those guys. And we talked about commodity prices, particularly gold. And the concern I have, right? I guess the overall analysis I would start with is we're in a downtrend of lower highs and lower lows. The momentum clearly bearish. But all of a sudden today, we're gapping up to the 200-day moving average. We're gapping back above Fibonacci support. The RSI actually finished the day just above 60. So this may be the beginning of a rotation from a bearish phase in gold to a bullish phase in gold. What I would love to see from this point on is getting above the 200-day moving average. That's always an important sort of milestone in a recovery from a downtrend back to an uptrend. And also seeing the momentum continue to go higher, right? The RSI pushing above 60 and sort of remaining there. A higher low when we have a pullback, which we certainly most likely will have maybe as early as next week. Do we make that higher low in gold? But for the last week and a half, gold actually appearing to be a bit of a safe haven. From the moment we started hearing news from Israel and everything that's going on, gold has spiked pretty well. Today, just sort of the latest gap going higher. We're going to talk about bond prices in our mailbag. We have a question about the TLT, so I'll save my comments for that one. So let's look at some individual names here. The chart of Apple, before we get to that, I'll show you this chart. The ticker is SQQQ, and if you don't know what that is, it's the Ultra Pro Short QQQ. So it's a short leveraged, an inverse leveraged ETF playing on the NASDAQ 100. Look at the chart. I mean, does this chart look bullish or bearish to you? Forget what it is. Just look at the trends. We've gone from a downtrend, I would argue, to more of an uptrend, higher highs and higher lows. So I'm inclined to see this as a pattern of higher highs and higher lows, right? Kind of a constructive pattern. The RSI not getting below 40 during this phase, which is more of a bullish phase. That's the bearish NASDAQ ETF that we're seeing here. So on the inverse ETFs, when they start to look good, I get concerned about the major benchmarks. I would argue that's a fair assessment, I think, quickly of what we're seeing here. Flip that over and you have the chart of Apple, and that's why I think it's concerning, right? You had the last push above the 50-day moving average was repelled. We made a new swing lower in early September, a new low going into late September. We rallied into now mid-October, and now we're once again sort of testing the 50-day from above. So is this just the latest upswing in a downtrend pattern? The momentum overall is still quite bearish for Apple. So overall, I see this for now as a distribution phase. 200-day is going to be key. So $168, really an important level for Apple. That's the swing low from September. That's also the 200-day moving average. That holds, things aren't that bad. That does not hold. I think you really need to think about the prospects of an Apple going much further and what that means. By the way, I just posted a video to my YouTube channel called Market Misbehavior about an hour ago, talking about Apple using RSI to think about it in terms of leading indicator versus a lagging indicator. So make sure you check that one out as well. We'll show a semiconductor name, and I don't want to go exhaustively through a bunch of growth stocks, but there are a lot of patterns like the ones I mentioned with Apple, right? This one's even more concerning, I would say, because we're getting near to that 200-day moving average. We kind of rallied into a declining 50-day moving average, and today just rotating right back lower. So times when these charts could certainly be creating more of an upswing and showing that investors are coming in and pushing the price higher. We're actually getting the opposite. We're seeing stocks rally into resistance and then rotate lower, at least for today. I think this week is ending fairly in a weak position, right? Showing you there's a deterioration in some of these leading growth stocks. That should be doing quite well if we are in a recovery phase. And if this corrective phase is done and we're going to rally into year end, I'm not feeling that based on the shape of the charts here. We'll finish off here looking at some earnings names. United Healthcare, I want to highlight one stock gapping higher. So here it is, UNH pushing higher by about 2.6%. Nice updates, testing previous highs from the second half of 2022. Overall, pretty good chart, right? And you think about what makes this a good chart. Higher highs, higher lows, testing resistance and breaking above it. We're now looking at a pretty key resistance level. So I think getting above 550 would be a nice validation to this uptrend, but improving relative strength. The RSI is overbought, which I don't mind because that just means we're in a rally phase and we're seeing accumulation going into the highs. And again, given the overall backdrop of, I would argue, more of a bullish feel for equities, pretty impressive to see a stock like this really continue to push to the upside. It's obviously in the healthcare sector. Let's talk about the banks, right? The banks sort of leading off earnings season today. Concerning patterns as they evolve. This is JP Morgan. Now, earlier in the day, right, as I'm checking in after the open and looking what JPM is doing, I'm kind of encouraged. I'm thinking, wow, this is a stock gapping above the 50-day moving average, trading above 150, 151, 152. This is maybe the recovery, right? And this is what we talked about. Could we get enough of an upside catalyst from earnings that it pushes these names to the upside? But by the end of the day, all of a sudden, this becomes a pretty concerning candle pattern. This is what we call a shooting star candle, where you have an uptrend, you have an open, trading higher, closing back at the low, so very little lower shadow, a long upper shadow. That's a shooting star coming down from upstairs. That suggests the next 1 to 3 bars are more likely down rather than up. So it's suggesting basically people really excited on the initial news of earnings, but by the end of the day, all of that buying power met with selling pressure, which pushed us back below today's open. Talk about a short-term sign of a change in sentiment. That's just looking at one of these names. You can see Citigroup gapping above the 50-day moving average, closing back below it. Here's Wells Fargo, WFC. Not a horrible candle pattern. I don't know, you'd call this like a spinning top or something, but I don't think it's that big of a deal. But it is a big deal, I would say, that we're gapping up, trading up to moving average resistance, and then failing to get any sort of upside above there. Here's BlackRock actually trading down toward the lows. And this is actually a doji candle at the lows, which suggests a short-term bounce for what it's worth. But overall, I mean, these are all charts that have struggled here, and where I think today could have been a better upside catalyst for stocks like these ones that we've featured. Most of them really struggling to finish strong today. That's it for our market recap. Boy, quite a lot to talk about. This was a day with a lot of movement, so we did our best to cover some of those different charts and indicators. We're going to get to the Final Bar Mailbag here in a minute. Just as a reminder, the mailbag is always open. Our email is the best place to get your questions to us. What are you running into as you are analyzing the markets, as you are using the Stock Charts platform, and you are trying to leverage the tools of the technical analyst? Our email is thefinalbar@stockcharts.com. We're on the X/Twitter @FinalBarSCTV. And on our YouTube channel, just put a comment below the video that you're watching, or drop a question or comment into our live chat. We'll gather all of those and hope to answer one of your questions in our future mailbag segments. Also, as a reminder, we're going to do a live Q&A on this show coming up this Monday. We're going to start off every Monday doing a live Q&A. I'll do a quick market recap, and then we'll go all to the chat. So make sure you join us live if you can at 4 p.m. Eastern. We'll set the stage with the market recap, and then we'll have a good discussion based on the questions that you guys are asking. Should be a lot of fun. We're excited to incorporate that live Q&A, that interactive nature of YouTube into our show starting on Monday. So look forward to having you join us there. Let's open the Final Bar Mailbag and get to question number one. Some really good questions on a couple of different topics here. Question number one, what's the difference between the McClellan Oscillator and the McClellan Summation Index? And thanks for asking about these indicators. I've brought up the McClellan Oscillator many times on the show. It's part of my Mindful Investor Live chart list, which is a group of charts that I keep updated on the Stock Charts platform. The one that I think you were talking about is this one. So this is a chart that I featured here. It's not updated for today's close, but based on what happened today, I'm 100% sure that the indicator will go back below zero today. So this recent upswing in the McClellan Oscillator looking a lot like what we saw in late August, which was a brief couple days above the zero level and then back to negative. It looks like that's how we're going to finish the week. We have to wait until we sort of polish all the end of day data, make sure we've got the official closes in there. But I think most likely we're going to get that indicator flipping negative here. And again, that just means, again, a risk off positioning in the short term going into next week. And the red shaded areas certainly more weaker than strong. Although sometimes it's more of a time correction. In general, good things have not tended to happen when the indicator is below zero because the advanced decline data is just not very strong. And it's telling you that there's more down moves than up moves over time. That's what the indicator is really calculating. So the McClellan Oscillator looks at basically some moving average treatments of raw advanced decline data for the New York Stock Exchange, and then we use what's called a ratio-adjusted McClellan Oscillator to calculate this. And it's basically designed to turn the advanced decline data into an oscillator like RSI. Super simple. Above zero is bullish, below zero is bearish. Now the McClellan Summation Index, a little different. And if you type something like McClellan Summation into the little magnifying glass, make sure you're looking at chart school articles, and you'll see articles like this talking about the McClellan Summation Index. I'd encourage you to read this article in a little more detail because what the McClellan Summation Index does is basically take the McClellan Oscillator and look at it over time. So it turns it into more of a trend-following device using the McClellan Oscillator. So it's sort of an optimized version of the raw advanced decline data. Now, you can actually use them together, and the charts that you'll see on the article that I'm showing you here actually show how the McClellan Oscillator can be used in conjunction with the Summation Index. And overall, the trend in the Summation Index is pretty powerful. I actually have the Summation Index in my breadth indicator list. We'll see what it's showing you right now. So here's the McClellan Oscillator, raw data above or below zero. Here's the McClellan Summation Index. And I have a little bit more longer term time frame. So this is looking at the last 5 years. Generally speaking, my experience, I rarely refer to the Summation Index because the longer term trend, I feel like I have a lot of other tools that kind of help me capture that movement, I guess is how I would describe it. So I'm using all the other techniques that we talk about on the show to sort of get a sense of where the S&P is headed. And that's really what the Summation Index is trying to do, is aggregate that raw McClellan Oscillator data and turn it into more of a longer term indicator. I kind of am fine using what I do and then using the McClellan Oscillator as a way of thinking about that tactical or that short-term time frame. By the way, if you want more information about those, as I mentioned, click on the magnifying glass, type McClellan Oscillator or McClellan Summation Index, look at the Chart School article, and you can get details about how they're calculated, how they work, and some really interesting examples showing you the relationship. I mentioned that Mindful Investor live chart list, by the way, and if you want to get that, click on the Articles tab. In the upper right, switch to my blog, which is called The Mindful Investor, and you'll see a live chart list right at the top. Now, that'll take you to the live version of these charts. Whether or not you're a Stock Charts member, you can access the live versions. If you are a Stock Charts member, which you, of course, all should be, click on Save to Chart List. You can save it to your own login, edit them, make changes to them, delete whatever you want, but make them your own, and you are welcome to them. Let's get to question number 2. Dave, are we in the right shoulder of a massive head and shoulders bottom on the HPE monthly chart? Let's take a look. I've actually not taken a look at the, so HPE is Hewlett Packard Enterprise. You might be familiar with HPQ, Hewlett Packard. This is a related company, but let's go to the monthly chart. All right, so here I'm looking at the monthly chart of HPE. You can see that this was a spinoff in mid-2015, if I remember correctly. You can see overall we're obviously much higher than we were at that offering price. And I think your question is this, right? Is this a big inverted head and shoulders or a head and shoulders bottom, as you called it? I mean, maybe the problem I would have. The problem I have with that is on an IPO or like a secondary offering, any chart like this, where you're sort of starting at the beginning and you have a big pattern. I have a problem with that only because is it really telling you that this is an inverted head and shoulders with a huge upside from this? I don't know, and I tell you the reason why that's tough to make that call is because technically what you need to do is then if this is the left shoulder and the head and the right shoulder, and you need to take the neckline, which would be that, which takes the low between the head and the left shoulder, the low between the head and the right shoulder. There's a neckline that's kind of sloped the wrong way, and we still actually haven't broken it. So what you have to remember about a head and shoulders topping pattern or head and shoulders bottoming pattern, in either case, it's all about the neckline. You think it's about the shape of the pattern, but it's really more about the neckline because the head and shoulders top, an ideal one, has a particular shape. The bottom has a particular shape. And what makes that important is when you break the neckline, it tells you that something is different, that something's changing. In this case, you really haven't broken the neckline yet, so you can't call it an inverted head and shoulders bottom yet until you break the neckline. And the problem is necklines really should be more like that. You ideally want a neckline that's sloping downwards a little bit. That's actually more of the traditional way that this kind of pattern is shaped. So what can you call it, though? I would have no problem saying that this is a chart in an accumulation phase, if that makes you feel better, because we've gone from a low here to a higher low and a higher low. And as long as we keep making higher lows, and now we've actually broken above resistance and we're making kind of a higher high, I think that's encouraging, right? I think the fact that we've just sort of take this as sort of the general level of resistance and we've broken above it, I think that's super encouraging. So this might be what you're seeing on the chart, and you say, is this a massive head and shoulders bottom? I would say no, it is not a massive head and shoulders bottom based on the definition and the rules that are involved with that pattern. Is this a stock breaking above a long-term resistance level coming out of the offering and making a pattern of higher lows, and is it fairly constructive as long as we hold above that level? I would agree with everything that I just said. So that's how I would answer your question, and thanks for asking about the monthly charts. Kudos to you that asked the question for looking at monthly charts. You'll note a lot of my guests, as things are getting choppy, as things are getting noisy, they're not bringing 5-minute or hourly charts of the major averages. They're bringing weekly, monthly charts, and that's a natural progression that you go through as a strategist. When things get uncomfortable, you always take a step back, right? When things are unclear, take a step back and just really see how the bigger picture is evolving. So credit to you for looking at the monthly charts. I'm a big fan of taking a step back in this sort of environment. Well done. Next question, what's most important to watch for decision making? The S&P 500 index, the SPY ETF, or S&P futures? So I don't know if there's a right answer to that. I would say for each of us, there's a right answer that makes sense. There are a lot of different ways you can measure what the market is doing, right? And I think that quote unquote the market means a different thing for a lot of different people, just in terms of the time frames we're thinking about, but in terms of how we measure it. I've talked a lot with people like Greg Morris, who is one of my mentors and wrote a number of books on technical analysis, particularly on market breadth and creating models based on technical indicators. He likes using the NASDAQ as a main benchmark, the NASDAQ composite, because in his opinion, that's sort of the measure of risk. And if you're trying to understand risk on versus risk off in the equity space, growth stocks as reflected by the NASDAQ composite are the best thing to look at. So he actually uses the NASDAQ as his main benchmark for a lot of systems. I remember talking with Charlie Kirkpatrick years ago about doing a similar thing with the NASDAQ. I use the S&P mainly because I've worked with big money managers for a number of years, and they often, if not all, look at the S&P 500 as the main benchmark. That's where a lot of passive assets are. So we need to outperform the S&P 500 as a way of generally having a purpose of managing actively. So I think, thinking of the S&P 500 as the benchmark to beat, I think is a good place to start. Now, whether you use the SPX or the SPY or S&P futures kind of depends. I would say on stock charts, S&P futures are a tough one because we don't have enough futures and commodities data yet for that to be a really good benchmark to use. So I would avoid that for now. We are building up our coverage of that area of the market. So hopefully very soon that would be an option. But most equity investors don't look at the futures primarily. You look at the SPX or the SPY. What you need to know about the stock charts platform is it depends on whether or not you want to include dividends. $SPX on our platform actually does not include dividends. It's actually looking only at price, and dividends are taken out of the picture. That's why at the bottom of my page, you'll notice that I always do a stock relative to SPY and not SPX. That's because our raw price data uses adjusted data, so it includes dividends. So I want to use a benchmark that includes dividends as well. That's why if you chart the SPX, $SPX, colon, or relative to SPY, which is the ETF, you see this relative line goes steadily down. It's down like 3% over time. That basically is because that's the dividend component that is included in the SPY but is not included in the S&P, and that's why that line goes steadily down. Those are just the dividends that are included in one and not the other. So in general, when I'm bringing up a stock, I'm using the stock chart's default adjusted data. So I'm doing it relative to the SPY, and that's sort of the main way that I would do relative strength. If I'm looking at the markets themselves and I just want to know what's going on, I would always use the SPX because that's what most people talk about. Those are the levels people know, and that's what people want to be aware of. It's changing over time, and I'm finding more and more people are looking at the QQQ or the SPY and are familiar with levels and what they're looking at. For me, the S&P 500 is still going to be it. I think that's it. The only other thing that I would mention, just to kind of spur your thinking, is the S&P 500 index had an adjusted open. I actually don't think that's the case anymore, but I don't know for sure, so I don't want to point you in the wrong direction. I know the SPY being an ETF is a true open. The market opens, there's an opening price, and it goes. The S&P 500, a lot of other indexes actually have a fixed open or an adjusted open where it's kind of an artificial one. So the candle patterns, I would always look at the SPY or the S&P futures because those are a better reflection of the open market activity related to the S&P. That was a bit of a long-winded answer, but I hope that answers your question. I tend to use the S&P as my main benchmark, the cash index. If I'm doing anything relative to a benchmark, I use SPY, and for the reasons that I just mentioned. Next question, and this is one that came, I think, from the show yesterday. This was in our live chat during my conversation with Chris Verone. And it was from Chris B, who asked, how long can the TLT long bonds continue to drop? That's such a good question, and I appreciate you asking that. It was really interesting talking with a number of my guests. If you listen, there are a couple consistent questions that I like to answer guests coming through the Final Bar. The main thing is, where do you see an opportunity right now? Regardless of what they say, okay, great, where are you looking? Like, where do you see an opportunity? Where would you be positioned? Some way that I can tease out where they see something that they like. The other one would be main levels of the S&P or the major benchmarks, like what's your overall thinking and what would change your mind. And then I'm often asking people about the interest rate environment. How important is that to you? And what do you see going forward? What do you think about the Fed? If it's the right guest to ask that kind of question, I like to go there. And I love some of the questions we had recently, some of the answers I heard recently about how to think of this. And, the way that I would generally summarize it is, often, I was told never confuse the bottom of the page with support, never confuse the top of the page with resistance. It's so often to see something that has gone down so much and think, okay, that's gone down so much, obviously it can't go down forever. And if you hear that voice in your head telling you something should go up because it's gone down a lot and it can't go down forever, immediately think of the opposite, right? That is probably not a great call, because I would argue the chart will tell you when it's not going down anymore. But just because the TLT has gone down to 85 does not mean it can't go down to 75 or 65 or even 30, theoretically. Unlikely, but certainly possible. And you have to remember that that's true. Even though the 10-year yield is up to 4 or 5%, doesn't mean it can't go to 6, 7, 8%. Those are all possible numbers and certainly could happen. And you have to think about what it takes. Again, we're in the midst of a rising and escalating conflict in the Middle East with potential far-reaching implications if it continues to grow in magnitude. And all of a sudden, it does not take much. It's a very quick moment where all of a sudden you realize, okay, the implications of what's happening there actually have far-reaching impact. And so I think it's a really good time to consider some of these outlier scenarios. You probably, in a normal environment, would underplay the likelihood of bond prices continuing to go down. I would think about what that might look like. Think about a rally in bonds and what that might look like. Overall, I would say, even though we're seeing a bounce in bond prices here this week, which is totally fair, they could continue to go higher. For now, I see the trend in the TLT as down. So I'm less about how low could it go. It could go to 82, and then you want to start buying bonds. For me, it's more about the trend, and it's more about the direction of this movement. By any technical tool that I would bring to bear on a chart like this, I'm seeing lower highs and lower lows. I'm seeing the momentum clearly in the bearish range. We're down below 2 downward sloping moving averages. We've made a new low. Those are all things that are the characteristics of a bearish chart. So I would talk about bond prices rallying in more of a medium-term, long-term sort of time frame, when all those things that I just described are no longer the correct way to describe the chart of bond prices, which means the momentum has to improve dramatically. We have to regain the 50-day moving average at least. We put in a higher low and a higher high. Those sort of general basic principles that tell you a downtrend is reversing. So how long can TLT continue to drop? A lot longer than you probably want would be my short answer. But I would think of it in terms of a trend follower. Recognize the trend is down. Look for signs that that downtrend is over. And again, based on what we talked about, I'm not seeing that yet. And I think a number of my guests have kind of echoed that thesis as well. Final question here, then we have to wrap it up. This came from our live Q&A earlier this week, I believe. What is the best indicator you use for reversals? And I really appreciate that. You know, a lot of the charts that we talk about on the show are, and the techniques that I talk about are really more trend following. And you know, what you have to remember is there are two general ways to do this sort of thing, investing in equity and ETFs. And I'm simplifying to a great degree, but you can either be a trend follower or you can be a contrarian, right? You can be a growth investor following trends that are working and buying strength and hoping that that continues. Or you can be a contrarian, looking for mean reversion, buying things when they're undervalued, when they're really beaten down, and betting on that changing, those value conditions to alleviate. A lot of the charts we talk about are trend following, right? On the chart of the TLT or Apple, we talk about the trend and what we would need to see the trend change. But as a contrarian, you want to start looking, in my opinion, at two different things. One would be leading indicators like bullish divergences, and this is, I mentioned the video on my Market Misbehavior YouTube channel, talked about this chart of Apple and what's called a bullish divergence. You have lower lows August into September, higher lows in the RSI. That's a bullish momentum divergence suggesting that maybe this downtrend is over, right? So that's one of those early warning systems. Look for a stock that's going lower, but you start to see this pattern. New lows in price, higher lows in RSI. And we've seen that at times, not just here on the chart of Apple. We've had a lot of charts that we've shared on the show here in recent months showing that type of pattern and what that represents. The other thing you can do, and I'll switch to a different chart here. The other thing you can do is look at an indicator like MACD or PPO. PMO is the one that our friends at Decision Point use, Carl and Aaron Swenlin. There are a number of other indicators that are really designed to help you identify a chart that is in a downtrend where now the trend is starting to turn. Not way after the fact, but it's just starting to turn. This is the chart of Home Depot, and I have the PPO indicator, the second panel below. Look back when the indicator has gone down a lot and then gives this buy signal where the black PPO line crosses up through the signal line, which is in red. You can see a lot of times this coincides with some pretty key bottoming points, right? Points when that downtrend is over and the prices started to stabilize. And a lot of times early on, as it starts to reverse, you get those sorts of buy signals. Home Depot may be doing one right now. It's actually really kind of chopped. It's in this pretzel kind of mode. It's sort of touched, they're on each other, but not really differentiating yet. So I don't know if it's a clear buy signal just yet. But an indicator like that is more built on mean reversion and buying weakness or buying a change from weakness to strength. I would be looking at those types of indicators. Divergences and something like a MACD or PPO. Those would be the two that I would use in my toolkit to try to identify reversals. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at the S&P 500 with a couple different indicators. And again, I'm concerned by, or not concerned by, I think I just clearly a pattern of lower highs and lower lows. The Thursday and Friday price action just seems to indicate that this is a lower high that we're experiencing and going into next week, and we'll see how things play out. This is the percent of stocks above their 200-day moving average, well below 50%. As long as this remains below 50%, I still see this as a market in distribution. This gets above 50%, I think there's hope. I think there's an opportunity for stocks to more broadly recover. It's still below 50%, even with some of the rallies that we've seen over the last week and a half. This is the VIX plotted upside down, and I've highlighted this 20 level. We are really close to breaking below 20. Or breaking above 20. We almost did that in May and June. We did not. We almost did that in early October. We did not. Now we're right back there. The VIX finishing the week just below 20. Going into next week, do we break above 20? And I think that would validate more of a risk-off feel for stocks. Chart number 2, great comments and discussions this week with some of my guests about the U.S. dollar. I thought Adam Turnquist on Wednesday did a great job talking about the dollar and why that's an important chart to watch during earnings season, particularly for multinational companies that have to deal with dollar strength and weakness in their financial planning. Crude oil prices potentially starting to rotate higher. This is the USO, pushing higher just to around $79. Here's gold actually starting to rally. September finished in a position of weakness. October is actually looking quite strong, and a nice gap higher on the GLD today to follow through on the recent upswing. Dollar, crude oil, gold, these are key charts to watch as we think about potential ripple effects of events in the Middle East. Finally, ConocoPhillips, the energy sector, the top performing sector. And again, I'm encouraged by the price action, getting back above the 50-day moving average, testing a new high, threatening that high from November of 2022. What I'm most impressed with is from the beginning of July to now mid-October, the relative strength line is strong. In general, owning charts and owning stocks and ETFs that are outperforming a benchmark is the best way to outperform the benchmark in your portfolio. Folks, that's a wrap for the show. I want to thank you so much for joining us this week on the Final Bar. Join us all next week, right after the close at 4 p.m. Eastern. We're going to be traveling to New Orleans for FinCon 23, but we'll have a show going for every day next week. Thanks so much for all of your great comments, and we'll have a live Q&A on the show on Monday. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good weekend.